Imagine you just got a raise. Not a small one, a real one. The kind where you go home and your partner hugs you and you both sit down at the kitchen table and do the math on your phones. And the math looks okay. Not great, but okay. Enough maybe to finally do it, to finally buy a house. So you start looking. And within about 48 hours, something happens that nobody warned you about. You don't get discouraged, you don't get frustrated, you get confused. Because the numbers don't add up in any way you can explain. The house is $499,000. You have decent credit, a stable job, some savings, and somehow, in ways you cannot fully articulate to your spouse or your parents or yourself, you cannot afford it. Not even close. This video is about why that happens, about who actually can buy a $500,000 house in 2026, what they look like financially, and why the answer is going to make you feel something between disbelief and low-grade fury. We're going to do the math together, in plain English, slowly. And by the time we're done, you're going to understand the housing market better than most people who work in it. Let's start with a number. The median home price in the United States right now is approximately $420,000. That sounds almost reasonable until you remember it's the median, meaning half of all homes cost more than that. In most coastal cities, in most desirable suburbs, in most places with decent schools and short commutes, you're looking at $500,000 as a kind of entry point. The floor, not the ceiling.
So we're going to use $500,000 as our benchmark, not because it's the most expensive, because it's the most instructive. It sits right at that threshold where the gap between what people think they can afford and what the math says they can afford is at its most brutal. And brutal is not hyperbole. That's the word. Here's the first thing you need to understand. When most people say they want to buy a house, what they're really saying is they want to make a monthly payment they can live with. They don't think about the house as a $500,000 purchase. They think about it as a monthly expense. Can I swing the payment? And that's a completely rational way to think because that's how you actually experience homeownership, month after month for 30 years.
So let's talk about the payment. You want to buy a $500,000 house, standard conventional mortgage. Let's say you have a 20% down payment. That's $100,000. $100,000, which, by the way, is more money than roughly 65% of American households have in total liquid savings, but we'll get back to that. You put down $100,000. Your loan is $400,000. Now, what's your interest rate? In 2021, you could have locked in a 30-year fixed mortgage at around 3%. Some people got 2.75%. At 3%, your monthly principal and interest payment on a $400,000 loan is about $1,686. At today's rates, which are hovering between 6.5% and 7.5%, depending on your credit score, lender, and which way the wind is blowing, your payment on that same $400,000 loan is between $2,528 and $2,797. That's roughly $1,100 to $1,200 more every single month for the same loan, on the same house, just because of when you bought it. Over 30 years, that rate difference cost you somewhere between $390,000 and $430,000 extra. That's nearly a full extra house. You're paying for two houses, but only getting one. This is the thing that does not get talked about enough in the mainstream coverage of housing affordability. Everyone argues about prices. Prices are up, prices are down, prices are stabilizing. But the payment, which is what actually matters to the actual human being trying to live somewhere, the payment is determined by two things multiplied together, price and interest rate. And in 2026, both of those numbers are elevated at the same time. That almost never happens. It happened once before, briefly in the early 1980s, and it produced the worst housing recession in modern history before those rates eventually broke. We're not in that exact situation, but we're adjacent to it in ways that should make you pay attention.
Okay, let's build out the real number, the full number, because the mortgage payment is only part of what you actually pay every month when you own a home. And this is where a lot of first-time buyers get ambushed. You have your $400,000 loan at 7%, your principal and interest payment $2,661 per month. That's the baseline.
Now add property taxes. The national average is about 1.1% of the home's assessed value per year. On a $500,000 home, that's $5,500 per year,
or about $458 per month. But if you're in New Jersey, Illinois, Texas, Connecticut, or a handful of other high-tax states, your effective rate could be 2% or higher. So call it $833 per month on the high end. We'll use the national average, $458. Now add homeowners insurance. The national average is rising fast because of climate-related losses, and it's now running somewhere around $2,200 to $2,800 per year for a $500,000 home. Let's say $2,500 per year, which is $208 per month. And if you're in Florida, California, Louisiana, or anywhere near a coast or a wildfire zone, good luck getting that coverage at any reasonable price. Now, if you put less than 20% down, you also pay PMI, private mortgage insurance. That typically runs 0.5% to 1.5% of the loan amount per year. At 1%, that's $4,000 per year on a $400,000 loan, which is $333 per month. We're assuming you put 20% down, so we'll skip this one. But most buyers cannot put 20% down, so this is not a small asterisk. Now add HOA fees if applicable. If you're buying a condo, a townhouse, or a home in a planned community, which is a large percentage of the inventory under $600,000 in most markets, you're paying HOA dues. The national average is around $200 to $400 per month. Many are higher. We'll say $300. And then there's maintenance. The old rule of thumb is 1% of home value per year. On a $500,000 home, that's $5,000 per year, or $417 per month. Some financial planners say 1% is too conservative, and the 2% is more realistic, especially on older homes. We'll use 1%. So let's add all of this up. Principal and interest, $2,661. Property taxes, $458. Insurance, $208. HOA, $300. Maintenance reserve, $417. Total monthly cost of owning a $500,000 home is $4,044.
No PMI, because we're assuming 20% down. No HOA if you're buying a standalone single-family home in a non-HOA neighborhood. But even stripped to the basics, without HOA, without maintenance reserve, just the mortgage plus taxes plus insurance, you're at $3,327 per month. Let's use $3,327 as our conservative floor, because that's the number that cannot be avoided. That's the absolute minimum every month, no matter what else is happening in your life. Now the question is, what income do you need to support that payment? Lenders use something called the debt-to-income ratio, your DTI. It's one of the most important numbers in the mortgage world, and most people have never heard of it until they're sitting across from a loan officer.
The rule is simple. Your total monthly debt payments, including your new mortgage payment, divided by your gross monthly income, should generally not exceed 43%. Most conventional loans prefer it at or below 36%. The 43% threshold is sometimes called the maximum qualifying threshold. It's not a recommendation, it's the ceiling. Let's use 36%, which is what you typically see in a well-qualified buyer scenario, someone who's going to get a good rate and a smooth approval. If your mortgage payment, plus taxes, plus insurance, is $3,327, and that represents 36% of your gross monthly income, then your required gross monthly income is $3,327 divided by 0.36. That's $9,242 per month, or $110,900 per year before taxes. But wait, that 36% assumes you have zero other debt. No car payments, no student loans, no credit card minimums, no personal loans, nothing. The 36% is the total. If you have a $400 per month car payment, which is below average for a new car in 2026, your available mortgage DTI drops to 32%, which means your maximum housing payment drops to $2,957, which means either you need more income or you need a cheaper house. And most people have debt. The average American household carries around $6,000 in credit card debt, a car payment, and often some student loan burden. The student loan situation in particular is not small. The average monthly student loan payment for a borrower who graduated in the last 10 years is somewhere between $300 and $500 per month. And since 2023, those payments are back on after a long pandemic pause. So realistically, if we account for a car payment and a student loan payment and maybe $100 in minimum credit card payments, let's add $900 in monthly debt obligations. Now your available housing budget at 36% DTI is $3,327 minus $900, which means your income needs to support $4,227 in total debt at 36%, requiring a gross monthly income of $11,742 or $140,900 per year. For two earners, that's roughly $70,000 each. For one earner, that's a salary that puts you somewhere in the top 20% of individual earners in the United States. This is not the conversation anyone is having. This is not what the cheerful real estate agent at the open house on Sunday is going to tell you. She's going to tell you the market is competitive and you should move fast because there's another offer coming in Tuesday.
Now let's talk about the down payment, because this is where the fantasy completely collapses for most people. 20% of $500,000 is $100,000. $100,000. Say that out loud a few times. Roll it around. Think about how long it would take the median American household, which earns about $78,000 per year before taxes, to save $100,000. After taxes, Social Security, and Medicare, that household brings home maybe $62,000 to $65,000. After rent, food, transportation, health insurance, utilities, childcare if applicable, and all the other things that constitute living in the modern world, the average American household saves somewhere between 5% and 8% of their income in a given year, maybe $3,000 to $5,000 if they're being disciplined. At $5,000 per year of savings, reaching $100,000 takes 20 years. 20 years of perfect savings discipline, no emergencies, no periods of unemployment, no medical debt, no divorce, no nothing. Just straight line saving from the moment you get your first real job until you're in your 40s. And that's before we talk about the closing costs. Closing costs on a $500,000 home typically run between 2% and 5% of the purchase price. That's another $10,000 to $25,000 that you need liquid and available on the day you close. Most of it is not rolled into the loan. It's cash on the table. So now you're not saving $100,000, you're saving $120,000. And when you get there, if you get there, the house has probably gone up in price. This is the treadmill problem. The target moves while you're running toward it.
Now, some programs exist to help. FHA loans allow down payments as low as 3.5%. Conventional loans allow as low as 3%. VA loans require nothing down for veterans. There are first-time buyer assistance programs in various states. These are real, these are useful, and they do help people, but they all come with trade-offs. A lower down payment means a larger loan, which means a larger monthly payment. FHA loans come with mortgage insurance premiums that never go away until you refinance into a conventional loan. State assistance programs often have income caps that exclude middle-income earners who still can't afford to buy. The point is not that there are no paths. The point is that every path requires something that most people, by the actual numbers, do not currently have.
Let's meet the person who can actually buy this house. Their household income is at least $120,000 per year, ideally closer to $140,000 to $150,000 with some existing debt. Their credit score is above 720, ideally above 760 to get the best rate tier. They have $100,000 to $125,000 liquid and available for the down payment and closing costs, money that is not in their retirement account, not in their kids' college fund, actually accessible. They've been in the same job or field for at least 2 years because lenders verify employment stability. And they have managed to do all of this without catastrophic debt. Who is this person? According to census data, a household income of $120,000 or more represents roughly the top 25 to 30% of American households. The liquid savings requirement of $100,000 plus excludes a very large chunk of even that group because income and wealth are not the same thing, and a lot of high earners spend what they make. There's actually a word for this phenomenon in personal finance circles. Henry, high earner, not rich yet. People making good money, sometimes excellent money, who are stretched by rent, student loans, childcare, and the general cost of living in 2026 and cannot access the capital needed to become homeowners despite their income.
The realistic universe of people who can buy a $500,000 home right now without significant family help, without an inheritance, without an existing home to sell is smaller than at almost any point in the last 40 years. Some estimates put the share of American renters who qualify for a median-priced home at around 15%. In 2020, before the rate surge, it was closer to 45%. In 4 years, the pool of eligible buyers shrunk by 2/3. That's not a blip. That's a structural transformation. So how did we get here? Because this did not happen by accident. And if you want to understand where we are, you have to understand the sequence of events that created it. The story starts in 2008.
The financial crisis destroyed the housing market. Prices collapsed, lending standards tightened dramatically, and construction of new homes essentially stopped. Builders went bankrupt, workers left the industry, and the institutional muscle memory for building at scale atrophied. For about a decade, housing starts, the number of new homes being built, were dramatically below historical norms. The country needed somewhere between 1.2 and 1.5 million new units per year to keep up with population growth and household formation. It was building closer to 750,000 to 900,000 for most of the 2010s. That created a structural supply deficit, a hole in the market, fewer homes relative to people who wanted them. Then, in 2020, two things happened at once that poured gasoline on the smoldering fire.
First, the pandemic changed where people wanted to live. Remote work unlocked demand in secondary markets, suburbs, and smaller cities that previously had little competition. Everyone, everywhere, suddenly wanted more space. Demand surged across the entire country simultaneously, not just in a few hot markets. Second, the Federal Reserve cut interest rates to near zero to prevent economic collapse. Mortgage rates fell to historic lows. Suddenly, people who had been sitting on the sideline could afford much more house for the same monthly payment. The purchasing power of buyers exploded overnight.
Supply was already low. Demand just spiked. Prices went up fast. From late 2020 to mid-2022, median home prices increased by something like 40% nationally. In some markets, 60%, 70%, more. Then in 2022, the Fed turned around and raised rates at the fastest pace in 40 years to fight inflation. Mortgage rates went from 3% to 7% in about 18 months. Monthly payments on the median home nearly doubled. But prices didn't come down to compensate. They barely budged. And this is the cruelest part of the current moment. In a normal rate environment, if rates go up, home prices should fall because buyers can afford less. The monthly payment stays roughly the same. Prices just adjust. That's the theory. That's not what happened. Prices stayed elevated for a specific and somewhat perverse reason. The people who bought or refinanced in 2020 and 2021 at 2.5 to 3.5% did not want to sell. Why would they? If they sell, they have to buy their next home at 7%. They'd be trading a $1,600 mortgage for a $2,700 mortgage on a comparable property. Nobody does that voluntarily. So they stayed put. Inventory dried up. The number of existing homes for sale collapsed. And when there's nothing to buy, prices don't fall even if buyers can't really afford them. Economists have a name for this. They call it the lock-in effect, and it's been one of the defining features of the housing market since 2023. The people who own homes are trapped in them, at least economically, and the people who want to own homes are trapped outside. Both groups are stuck, just in completely different ways. Now, something else has been happening simultaneously that doesn't get nearly enough attention, and it's important because it changes the nature of who you're competing against when you try to buy that $500,000 house. Institutional investors. Starting around 2012 and accelerating dramatically after 2020, large investment firms and real estate companies began buying single-family homes at scale. Private equity-backed companies, publicly traded REITs, and smaller but still formidable investment entities began purchasing homes in high volume, converting them to rentals and building portfolios of tens of thousands, in some cases hundreds of thousands of properties. The largest of these firms, names like Invitation Homes, American Homes for Rent, Progress Residential, owns somewhere between 300,000 and 600,000 single-family homes combined. That sounds like a large number until you consider that there are roughly 86 million owner-occupied homes in America.
America, at which point it sounds almost trivial. But here's the thing. Institutional buyers are not distributed evenly across the country. They are concentrated in specific markets, Sunbelt cities, suburban Atlanta, suburban Phoenix, suburban Dallas, parts of the Southeast, areas with strong rental demand and historically lower home prices. And in those specific markets, they can represent 20%, 30%, sometimes higher percentages of purchase activity in certain price ranges.
And they don't need mortgages. They buy with cash. When you're a first-time buyer with pre-approval paperwork and 30 days needed to close, competing against a cash offer that can close in 10 days with no contingencies, you lose. Not every time, but often enough that it changes the psychology of the market. It changes what sellers expect. It changes the norms around bidding. There is genuine debate among economists about how large an effect this actually has on prices. Some argue it's marginal. Some argue it's significant. The real-world experience of buyers in Atlanta and Phoenix and Nashville probably informs this debate more than any academic paper. When you've lost 5 offers in a row, one of them to a company you later Googled and found owns 80,000 houses, the statistical insignificance is cold comfort. Let's zoom out for a second, because there's a bigger question underneath all of this. Home ownership in America is not just about shelter. It's the primary vehicle through which middle-class families build wealth. The equity that accumulates in a home over 20 or 30 years is, for the vast majority of American households, the bulk of their net worth. Not their 401k, not their investments, their house. When you take that vehicle away from a generation of people who were perfectly productive, perfectly responsible, fully employed members of society, you're not just making their rent higher, you're changing the trajectory of their financial lives permanently. The median net worth of a homeowner in the United States is approximately $300,000. The median net worth of a renter is approximately $8,000. You can debate how much of that gap is caused by home ownership itself versus the income differences that allow some people to buy in the first place. Smart people disagree on this, but the wealth gap between owners and renters is large, it is real, and it has been growing. A generation of people priced out of home ownership during their 20s and 30s will arrive at retirement age with dramatically less wealth than their parents had at the same age, not because they failed, not because they were irresponsible, but because they tried to enter a market at exactly the wrong historical moment, and the math simply did not work for them, regardless of how hard they tried. That's not a minor policy footnote. That's a long-term demographic and economic shift with consequences we haven't fully calculated yet. Now, I want to be precise here because this is where a lot of housing content slides into either catastrophism or cheerleading, and neither one is useful. The housing market in 2026 is not uniform. It is not the same everywhere. There are markets where prices have softened, where inventory has improved, where the affordability calculus is less brutal than the national picture suggests. Austin, Texas, for example, saw prices correct significantly from their 2022 peaks as supply increased. Parts of Boise, Idaho, parts of Phoenix. Some of the markets that ran up fastest came down hardest, or at least softened meaningfully. There are also incomes in certain sectors that have kept up with or exceeded price appreciation. Technology, finance, law, medicine. If you're a software engineer at a large tech company or a financial analyst at a private equity firm, the housing math, while uncomfortable, is not impossibly out of reach. You're not getting a good deal. Nobody's getting a good deal right now. But it's at least arithmetically achievable. And there are geographic arbitrage opportunities. If you live in San Francisco or New York, $500,000 buys you approximately nothing. If you move to Knoxville, Tennessee, or Greenville, South Carolina, or Spokane, Washington, $500,000 buys you a genuinely nice house. Remote work has made this trade-off more accessible than it's ever been. People are making it.
So the picture is not uniformly bleak, but the average experience, the median experience, the experience of someone with a median income trying to buy a median home, is genuinely difficult in a way that has not been true for most of the past 50 years. Here is the uncomfortable math, summarized as cleanly as possible. To comfortably buy a $500,000 home in 2026 with a conventional 20% down payment at current rates, following standard lending guidelines, you need a household income of approximately $110,000 to $150,000 per year, depending on your existing debt load.
You need $100,000 to $125,000 in accessible savings. You need stable employment for at least 2 years and a credit score above 720. The percentage of American households that meet all of those criteria simultaneously is somewhere around 15 to 20%, which means that for roughly 80% of American households, a $500,000 home is not a stretch. It's not aspirational. It's not something they need to save harder for or find a better rate on. It is simply by the arithmetic, not an option at this point in time. That's the math, and the math doesn't care about motivation. The math doesn't care how much you want it. The math doesn't care that your parents bought their house on one income in 1987 and told you to just be patient and save. The math is the math. What changes this?
Rates come down. That's the most obvious lever. If mortgage rates fell to 5.5% or 5%, the affordability picture improves meaningfully. Monthly payments would drop, more buyers would qualify, locked-in homeowners might be willing to sell if the penalty for doing so decreased, inventory could improve. But rates are not guaranteed to fall. Inflation has proven stickier than expected. The Federal Reserve is not in the business of optimizing for housing affordability. It optimizes for its dual mandate, price stability and employment. If keeping rates higher is what it takes to control inflation, housing affordability is not going to move the needle on that decision.
More supply is built. This is the structural, long-term solution that most economists across the ideological spectrum agree on. If you build more homes, prices eventually moderate. But construction is constrained by labor shortages, material costs, zoning restrictions, permitting delays, and the basic fact that building in the places people actually want to live, dense urban centers and desirable suburbs, is genuinely difficult. The zoning reform conversation has been gaining momentum in some cities and states. California, Montana, and a handful of other states have passed legislation to allow more housing density. This is real progress, but it takes years, sometimes decades, to translate into meaningful inventory.
Incomes rise faster than prices. Also theoretically possible. There have been periods, the late 1990s for example, when real wages grew significantly and helped improve affordability. But wage growth in most sectors is currently running below home price appreciation in most markets, which means incomes are losing the race. A significant price correction. This is what a lot of potential buyers are quietly hoping for. Another 2008. But 2008 was driven by fraudulent lending, toxic mortgage products, and fundamentally unsound buyer qualifications. The current market is characterized by the opposite: tight lending standards, qualified buyers, and a supply shortage. A crash requires either a massive supply flood, a demand collapse driven by unemployment, or some external financial shock. None of those are impossible, but they're not the base case scenario either.
The honest answer is that there is no clear near-term exit from the affordability crisis. There are partial solutions, gradual improvements, and markets that are better than others. But the structural math, the combination of high prices, high rates, low inventory, and stagnant real wages for the bottom 2/3 of earners, is not something that resolves quickly. Let me leave you with a thought that I keep coming back to. There's a concept in economics called a threshold effect. It describes a situation where a system functions normally up to a certain point, and then, past that threshold, the rules change. The system behaves differently. What worked before no longer works. Housing affordability in America may have crossed one of those thresholds.
For most of the post-World War II era, there was a general social contract implied in home ownership. You worked, you saved, you were responsible, and eventually, not immediately, but eventually, you could own a home. Not necessarily a mansion, not necessarily in your ideal neighborhood, but something. Something that was yours, that built equity, that gave you stability. That implied contract is fraying. And the fraying is not uniform, it's not total, and it's not irreversible, but it is real. The question that nobody can fully answer right now is whether this is a temporary dislocation, a painful but ultimately manageable period between two equilibrium states, or whether it's the beginning of something more permanent, a shift toward a country where a significantly larger share of people rent for their entire adult lives, not because they chose to, but because they had no other option, where wealth accumulation through real estate, the mechanism that created the middle class as we know it, is available only to those who already have wealth to begin with.
That question does not have a tidy answer. The numbers don't resolve it. The Fed chair doesn't have a hotline to
call with the answer. The real estate agents are not going to tell you. The mortgage brokers certainly aren't, but it is, without question, the most important financial question facing an entire generation of Americans right now. And the fact that we're spending more time debating whether to buy now or wait than asking why the system produced this outcome in the first place, that, maybe, is the most revealing thing of all.